Welcome back to Day 5 of RSM's Tax Summit Week 2021. This session is Surprise, Surprise, what healthy SALT revenues and state budgets mean for 2022. At this time, I'm pleased to turn our call over to our first presenter, Mo Bell Jacobs. Mo?
Thank you, Allison, and good morning to all of you. Thank you for joining today's SALT session. It's the final day of RSM Tax Summits. I've joined a few of these. I've found them to be very productive knowledge sharing, so I hope you've had the benefit of doing that too, or maybe listening to some of the recordings of the sessions that were made. So whether this is your 13th session or your first session, thank you for joining us, and we're glad you're here today. Today's session is our SALT year-end recap. We're going to take a holistic look at what we need to be thinking about for 2022 based on a lot of these 2021 actions. It was a very active year in legislatures and state legislatures, especially compared to 2020. I think from our collective perspective, we look at SALT not as checking a box or even a checklist, but a whole universe of considerations. So any action has a SALT consequence to it, and any tax decision on the federal level you make is going to have a SALT consequence as well. So hopefully there are some interesting topics today. We do have for the season a cornucopia of issues, so we may jump around a little bit, spend more time on some issues than other issues. It's action packed. If you have questions, feel free to ask them. We'll try to respond to them if we can in the session, but this panel, we will also attend the live chat lounge room after the session, so feel free to navigate over there. And if neither of those mediums work, we're happy to reach out to you after the session. One final comment, there is a participant guide in the materials for this session. We think you'll find that very useful. It discusses a lot of the concepts that we're going to discuss today, but in further detail. There's also very specific state actions, state legislative actions, so bills and things like that, and some description of what happened that we're not going to cover in the detail in this session. So I would encourage you to take a look at that. RSM also has a overall year-end planning guide as well. So if you haven't seen that, you may find that useful. It also has a SALT component to it. So our title, well, get us to the slide. Okay, surprise, surprise, what healthy state revenues and state budgets mean for 2022. I like that title. It sounds positive. Our panel today might be a little bit more cynical. And we'll talk about that. With me today, my colleague in W&T, David Bernori, Senior Director, and Jorge Rodriguez, a Senior Manager out of our New York office. Our agenda today is very, very simple. We're going to have a quick discussion on the state of the state. So what are we seeing? What does it mean for state budgets? And what do we need to be thinking about for 2023 sessions, which are about to begin? And then we're going to delve into some of the details, some of the issues we're seeing, the hot topics, and that should be the bulk of our session today. Finally, our learning objectives, there they are. I think at the end of the day, we want to grow smarter together, and hopefully we can accomplish that. So the state of the states, we're going to kick this off with a polling question, and this is a polling question I love to ask. I ask it every chance I get. What is the current state and local fiscal climate? I do change the responses, so if you've seen this before. A, utter catastrophe. The states are broke. The tax increases are on deck. B, it's a 50-50 mix of good and bad. Many states face fiscal pain when planning for fiscal year 22, but in many others, revenues are stabilized. C, most states have recovered from 2020 or getting back on track. And D, what pandemic? State, individual, and corporate tax cuts are likely in FY22. Some have already occurred in FY22. David, in 2017, I would say 80% of the responses were utter catastrophe. High level, 50,000 foot view. What's your take on this? As high level as we can get, what are you thinking? How do you feel?
Well, and we're going to talk about this in a little bit more detail in a few minutes, but I'm going with D or C because I'm bullish on the American economy right now, despite the problems we're having. Right, we're having all kinds of economic issues, but I'm pretty bullish on the economy, and I'm very bullish on state revenue projections, both for next year, this year, and the next year. So I'm pretty positive, I have to tell you.
we'll give our attendees a few more seconds to think about that. This is an opinionated question, of course. And it does change. I think, at the end of the day, we're going to get to the same response we always get to with this question. It's probably a mix. When we talk about our state economies and the state of the states, we're going to group them all into one single bucket. That's probably not the most appropriate way to talk about states because some are just vastly different than the others. So I would keep that in mind. This is when we say these trends and when we talk about the considerations, it's going to be general considerations for the country as a whole. Some states won't be in the same shape. So with 90% of the attendees, I am going to close the poll. And let's see what the responses were. Okay. It is not showing up on my screen. David, can you see?
I can, and it says 57% choosing B. It's a 50-50 mix of good and bad. A little bit more cynical than my view on it. 18% said most states have recovered. Only 4% said there's going to be more tax cuts likely. And 19% still say it's an utter catastrophe. So it is a mix, although most say it's a 50-50 mix.
Okay, well, let's see what's really happening right now. I have a lot of data and I have a lot of charts. I will save all of you from looking at those, and I'm just going to give you one chart, and we'll talk about it. So what we want to demonstrate here, this is percentage growth in total state and local tax collections comparing one quarter with the same quarter the year before. We start from basically at the end of the Great Recession, so we're looking at the recovery. It may be helpful to make this slide bigger on your screen if it's of any interest to you at all. Any data point above 0% means that there's been growth, and you can see there's a lot of data points. They're all over 0%. So we've grown in terms of total state and local tax collections every year, every quarter. The big dip, Q2 2020, that is our pandemic dip. We saw a quick recovery. You see Q3 data point is up there, and that is completely expected because a lot of the personal and corporate income tax filings were pushed to Q3, so we understand why that data point's there. And then we have three higher data points as well. Looking at that Q2 data point, and this is calendar year, so that Q2 data point is 33% growth over Q2 2020. That again, high data point, that was to be expected. But there's some things hidden in this data that we want to talk about. Q1, Q2, the first 6 months of the calendar year 2021 were really, really good for state tax collections. David, I know during our SALT Summit a few months ago, we said we think Q2 2021 was going to be the best year and the best quarter ever for tax collections, and it was. And it was a fantastic year for sales tax collections, or a fantastic quarter for sales tax collections. We've had multiple quarters of very, very solid growth after we saw this dip in collections and to kick off that pandemic. So there's a few things I want to talk about. Q1 2021, first 3 months of the year, very, very good for state and local tax collections. Q2, extraordinary. So was there a rebound? Okay. We weren't really sure 6-8 months ago what the rebound was going to look like. I think definitively we can say there was a rebound, but there wasn't just a rebound. I'm going to call this rebound plus, because we're doing better than we would have been doing on the same trend before the pandemic. If the pandemic hadn't even occurred, we're doing better. Looking at FY20, so now we're going to look at fiscal year FY20 with a slight decline from FY19, but calendar year 20 was very, very close to calendar year 2019 in terms of overall collections. Right now we have 4 consecutive quarters for total collections in the double digits. That's pretty impressive. Sales tax alone in Q2 was up 36%. Now we knew that number was going to be high, but we didn't know it was going to be that high. So from a nominal perspective, that is enormous. And I want to talk about why. I looked at the data for maybe the past 10 years, 2010 through 2019, to get the average state sales tax collection rate. It's a little bit under 4%. if you had a trend line, which I don't have on this map. And then we added in the last 6 quarters, including the pandemic drop through, let's say, June 2021. And just those quarters alone at a considerable and noticeable increase to the average growth rate for sales taxes over that 10, 12-year period. So I think that's pretty significant. A similar observation can be made for personal income taxes. So this is just not a dynamic for sales taxes. We know this is also continuing into calendar year Q3, which just ended. I have a couple of states here. Illinois, 13% better sales tax collections in October than October 2020. Massachusetts, 12% better sales tax collections. 17% for overall collections in Massachusetts. I've just read that this morning. So we have a lot of anecdotal data where states continue to collect solid revenue numbers above expectations, which is very important. So,
by the
David,
way, Mo, that's also true at the federal level. I read that there's federal tax collections are beyond expectations. So it's interesting to see that that's parallel at the state level.
I didn't even realize that, and that is interesting. So we have a lot of tax revenue growth by itself. Now, that's not all where state budgets get their money from, but it's certainly a big component of it. So we had this sharp decline with the pandemic, and then we had a rebound, and now we're having this rebound plus that I'm calling it. David, I've never seen anything like this in 14 or 15 years of practicing, where we had literally 8 months ago, maybe a year ago, we were scared that the states were going to collapse, and that doesn't even seem to be on the radar right now. What does this mean? What should we be thinking about here? And are there any other things going on that will impact state budgets?
Well, actually, Mo, there's a lot happening, right? And it's hard to pin down one thing, although I have an opinion on that. On the federal side, first the CARES Act and then ARPA pumped an enormous amount of money directly into the hands of state and local governments. There's no question about that. In fact, the feds pumped so much money into state and local governments that they haven't been able to spend it all. Right? There's a lot of local governments, there's a lot of state governments that are sitting on money that they haven't been able to figure out how to spend yet. And of course, the feds also gave individuals over the last year and a half a boatload of money, stimulus checks, enhanced unemployment, so on and so forth. And people largely spent that money, which no doubt resulted in more tax revenue. But the most important driver, in my opinion, of all of this, of the increased tax revenue, is that the economy has really rebounded pretty dramatically. And that is, and what will continue to be, what sustains healthy state and local budgets. I think, again, I'm very optimistic and bullish on the American economy right now. I think we're going to see this continue. And it's interesting. Everybody's worried about inflation right now. And folks should think about this. Inflation, of course, is terrible for people on fixed incomes and for a lot of low income folks, not a good thing. But inflation is actually very good for state budgets because state tax revenue, particularly income tax revenue, rose faster than inflation. And so I think you're going to see good state and local budget numbers going forward. But it's kind of a combination of the economy doing well and a whole bunch of federal money being pumped in.
That's really interesting, David. You mentioned ARPA as well. That's $350 billion to state and local governments, $200 billion just to the states alone. Yeah, there are some restrictions, and I know Jorge wanted to mention something about that. There are some restrictions and some litigation over that, but money is fungible, and that's still money going into the states. And I think you're right that a lot of states haven't even committed to spending that money yet, but it will help boost state coffers.
Yeah, those are great points.
You mentioned something, right? Yeah.
Yeah, first of all, David, I'll say for the states out there that can't figure out how to spend the money, we can fly them to New York or any of our sister states and show them the way. But no, in terms of, ARPA, there are at least two recent federal court decisions siding with the states. There are various states that have challenged. For those of you who don't know, ARPA, the Treasury Department issued regulations and set forth restrictions on the state's ability to use these funds, namely to not enact legislation that would lower tax rates. And there were some, exemptions and safe harbors for rate changes that were already in the pipeline. So what happened is that various states challenged, some of them lost in the initial round of litigation on this issue. The losses, as far as I recall, the court losses were primarily based on ripeness issues. In other words, the controversy was not quite ready for review according to those cases. Now in the second round, what I'm calling the second round of litigation on this, we see, I think, Kentucky and Missouri citing for the states and basically saying that these Treasury guidelines cannot restrict the state's use of the funds. And if states like Kentucky or Missouri or other states actually want to lower the rates, whether as a result of ARPA or otherwise, there can't be a tying in of the two, and it would violate the state sovereignty principles and even commandeering principles. So I think actually there's a lot more to see on this front. I think the Eighth Circuit is currently reviewing the appeal, and we'll see what happens. It might go up to SCOTUS, it might not. But stay tuned. A lot to be seen just on that front alone.
Yeah, if we see that, and if states are allowed to use that money to reduce taxes, that could be dramatic for some businesses. David, one final question on this point, because I want to get into some of the meat and substance of today's discussion. So things are good. Does that mean no tax increases, or states they're good to go? They're going to cut taxes?
Well, a couple of things are going on, right? So there's not been a lot of new spending, right? We have, in fact, many states are sitting on near record surpluses, multi-billion-dollar surpluses, and interestingly, as most folks know, almost no states during the last year raised taxes. There were a couple of exceptions: Connecticut, New Jersey, D.C., but not really big, significant tax increases. I also think, as importantly, the rosy budget picture has lessened the likelihood of new digital taxes and tax haven legislation because the states simply don't need the money. Now, there's always going to be politicians who want to raise tax burdens, no matter what the budget situation is. And you will see proposals in almost every state, because we always do, to raise some tax, excise taxes, income taxes, sales taxes, et cetera. And a lot of these folks are either motivated by a desire to fund new government programs or by a desire to right some perceived wrong, right? Economic justice, things like that. The good news, in my opinion, again, is that the good budget picture makes this harder, right? It makes increasing taxes harder because simply the states don't need the money right now. So I think there's going to be a lot of pushback and a lot of challenge to that. That can all change, by the way, right? You can have another COVID bout, an economic downturn, things like that. So stay tuned because it's a little bit fluid.
Yeah, that's really interesting, and one of our commenters mentioned that there are record federal revenues as well. Tax cuts this year, and this is in more detail in the participant guide I mentioned earlier. Arizona, Idaho, Iowa, Montana, Nebraska, New Hampshire, Oklahoma, all types of, in many cases, minor tax cuts, but both personal and corporate income taxes. We do have some tax increases. New York was one of those for high earners and certain businesses. And then D.C., you mentioned for high-earning taxpayers, that's under congressional review, but there's probably really no headwind to that. So I think our takeaway is, things can change quickly. They always do, but it doesn't look like there are a lot of headwinds right now. Even with we have some of the supply chain issues, not a lot of cars, maybe some difficulty getting electronics. but there's still a lot of taxable items out there, and people really appear to be buying them. So we're going to move on to our next polling question. Let's see, there it goes. Hopefully it's on your screen. How do you think the states will respond as they prepare for 2022 legislative sessions? And I guarantee you they're preparing right now, and they're taking a close look at what's happening at the federal level. Federal windfalls and state and local tax revenues will drop. Tax increases are likely. States will take a wait-and-see approach to potential federal tax reform that could negatively affect state tax bases. Unlike the TCJA, which expanded state tax bases and may be one of the reasons for positive revenue growth the last few years. They'll continue the income tax cuts from 2021 FY22. States will eye the expansion of sales tax base as an easy revenue generator while preserving superficial corporate tax cuts. Those are the minor corporate tax cuts because they just don't bring in a lot of revenue. And then all or a combination of the above. So we'll give you a few seconds to respond. I think we talked this out fairly well. There are a lot of unknowns, and there's a lot of activity at the federal level right now. We'll talk a little bit later about the pass-through entity workaround. There are some international provision changes, maybe some 163J changes. So those are things that the states may look at and may take some time to respond to.
And 86-272, we'll get to that as well in a minute.
That's right. So we'll give you a few more seconds to respond. I see about 88 responses. I want to make sure you guys get your CPE for joining us this morning. And then I'm going to go ahead and close this poll and take a look at the responses. Federal windfall is 11%. Tax increases are likely ahead. Yeah, I think we're not immune from tax increases. And I said one of the things we said earlier was that we can't look at the states as just one entity. Some states are in different positions. So I think certainly increasing the sales tax base, that's always on the table. Maybe even some personal corporate income tax increases. Quarter of you, states will take a wait and see approach. I think that's true in a lot of regards. And then 50%. All or some combination, which I think makes a lot of sense. So moving on, I apologize. I'm having a slide problem. Okay, so hopefully the MTC slide is on the screen.
Okay. It's on.
Okay, is anybody moving? Please do not move the slides if someone is. I apologize. We're having some internet issues and the slides are jumping around a little bit.
Hi, Mo. It's Allison.
So,
what slide are you looking to have that on?
The MTC slide.
You're on the 86-272 right now, which is I think what you want to be on, Mo.
That's perfect. That's perfect.
You're good.
David, we have a very big development right now. Regardless of what we think about this MTC guidance, we have a 60-year-old law trying to adapt to a modern economy. Can you give us some help in understanding what this guidance is and really what we need to be thinking about?
Sure, and we can talk about 86-272 for hours. In fact, we can probably have a whole session on it, obviously. But basically, the states have always disliked this limitation on their taxing authority and have construed the protection under 86-272 very narrowly. And the courts have supported them in that. And in fact, even the Wrigley Court, the Supreme Court said, yeah, we're going to construe this pretty narrowly. Very few taxpayers are protected in the modern economy because all you can do is solicit orders for tangible personal property. You can't really do more than that. And in the modern economy, people do a lot more. The MTC guidance, if adopted, will make a lot fewer taxpayers protected. And basically, if you have a website that was created after, 1995, the last time the Braves won the World Series and gas was like 70 cents a gallon, you will not be protected. Basically, if you have an interactive website where you can do anything post-sale right? If you have a question about your purchase, the MTC guidance basically says, yeah, you're no longer protected. And I think it's going to knock a lot of companies out of the 86272 protection because they have sophisticated, the websites today are super sophisticated, and you can do a lot of things. On top of that, you can sell all kinds of services through the website. And if you're selling services through the website, in addition to tangible personal property, warranty services, things like that, credit applications, and all of these companies have that, right? There's ways to get credit. There's ways to get warranty service. It knocks you out of the protection. And I think while I disagree generally with the approach because I think it's I think it really nullifies 86272. I'm not surprised. And we're gonna, we have clients that are protected by 86272 right now. Not a lot of them, but it's going to make it harder going forward. And we have our list on our chart actually is a pretty good. A list of what knocks you out right now.
Yeah, that's right, David. And I think a couple of points and observations. First of all, in light of Wayfair, this is, I think, a natural trend from the state's point of view to reconsider what the scope of 86272 is. That being said, this law has been in effect for 60 years. In addition, there has never been a federal legislative amendment to this law. And in terms of guidance from the judiciary, the Wrigley case, which I think you alluded to earlier, David, is the only Supreme Court case that I'm aware of that tried to clarify a little bit and actually didn't really do us much service in that respect. So we're left with this law from a statutory point of view, from a statutory construction perspective. I think the argument is very strong that the intent and the actual text of the statute was meant to provide a safe harbor for interstate commerce. And when you go back to, prior to, the Willis Commission, and prior to the Willis Commission, prior to the enactment of 86272, you see that, in fact, what they were doing corresponds to that sentiment in the business world. Now with the internet economy, with e-commerce, and also you throw in what's going on in the OECD with the base erosion initiatives and this minimum tax framework that is on its way, or apparently on its way, maybe not, but the protocols are there. And so all of those things, I think, lend support to, from a policy perspective in terms of the political environment and in terms of Wayfair, gives them cover. I think that this is ripe for challenge. There's going to be, to the extent, that the first question is what is the extent to which states are going to conform to this? We don't know the full answer to that yet. I specifically spoke with at least relatively recently, two state tax administrators who were cagey about whether or not their specific states were going to follow this guidance. But I think what we're saying here is absolutely correct and pivotal and very practical. Namely, taxpayers should assume that change is on the way in this arena, and 86272 is incredibly important to reserve positions, to apportionment analyses, throwback rules, throwout rules, all of that come into play for all kinds of taxpayers. So much to be seen in this space, and I think taxpayers should pay very close attention. And we'll cover M&A in a minute, but in the M&A space as well, which is incredibly active, I think it's very important to be aware that changes to positions, prior or historical positions that companies or taxpayers took based on 86272, the apple cart may be disturbed yet again post Wayfair.
Yeah, I will say, Jorge, the tax administrators I've talked to are not cagey about it. Off the record, they have told me they think that every state will eventually, certainly every income tax state will eventually adopt the guidance because it provides cover, right? The MTC says, hey, this is the way you should interpret this. And it's like, oh, this is the way we should interpret it. And I think there's a couple of things that are going to happen, though. One, there's a question about, I happen to think that the states, in order to adopt this guidance, will have to either make a change administratively or statutorily to adopt this. But there are state tax revenue people who think that if you're a member of the MTC compact, you don't have to do anything. You could just start enforcing it right now without any administrative or statutory changes. I don't think so. And I don't think states are going to do that because, one, they're going to open themselves up to litigation. There's going to be litigation over this, as you mentioned, and you're going to see lawsuits filed and challenges. I don't know if those lawsuits will be successful or not, but I think that every state's going to head down this road. And I think we're seeing the last legs of 86-272. I really do. I just don't think it's sustainable in the modern economy when you're trying to deal with electronic commerce and remote sales and things like that today. I mean, it was one thing in 1959. It's another thing in 2022.
I agree with the trend. But, David, what do you think about a potential challenge to this guidance to the extent that states adopt them based on the Internet Tax Freedom Act? Do you think that might have any plausible pathway in there?
Well, no, I think there's going to be a challenge. Whether no matter how they go about adopting it, you're going to have lawyers challenging this, and you're going to have some companies challenging this. And the argument's going to be, wow, you've basically nullified in the modern economy. You've nullified 86-272 in the modern economy, and you did it, MTC, and you didn't let Congress do it. And so this is illegal. It's invalid. It's whatever. Under the Supremacy Clause, 86-272 is still the law of the land. I just don't. Right. So I think there's an argument there because really, if you've got a website, and most modern websites will violate this guidance.
See, I think the statutory argument, and I haven't seen this in terms of materials out there, practitioners or scholars, but I think there might be an argument that the Internet Tax Freedom Act, to the extent it has now become permanent, right, as of 3-4 years ago, further supports the argument that the congressional intent, Congress doesn't restrict state tax activity very much, right? 86-272 and the Internet Tax Freedom Act are one of the few congressional pronouncements affecting state tax authority. But to the extent that the Internet Tax Freedom Act has been made permanent, that further corroborates the statutory argument that there in fact should be a safe harbor, notwithstanding Wayfair, notwithstanding the trend, globalization trend, clearly in favor of e-commerce. And therefore, some of this might have to be rolled back.
Yeah, I think it's a little bit early to to figure it out, but yeah, and we could, Jorge, you and I can talk about this all day.
So let's boil this down. Let's boil this down, guys, into a nugget, a takeaway for our attendees. Really, if you are two things: one, no state has adopted this guidance, but the guidance is out and it's final. And the other is that if you are taking it to an 86-272 position, or if you are considering an 86-272 position, you need to get familiar with what this guidance says. Is that an appropriate takeaway here?
Absolutely.
Okay. And take a look at some of these, David, you mentioned, or Jorge, just if you had an internet website, you may lose the protection. I'm looking here. One of these points on this chart is inviting, accepting applications for employment through a web-based platform. So if you're taking a position, if you're considering a position, read this guidance. And with that, we're going to jump to another polling question. Will the new PL 86272 guidance affect your business? So again, are you taking an 86272 position, or are you considering one?
Yeah, and think about that, Mo, while people are answering this. If you're accepting employment applications on your website, like every company has something saying "work for us," or careers with XYZ Corporation. Every company does that. We do that. RSM does it. Every company does it. And certainly any company of any size does it. And you could try to plan around this by tailoring your website, but companies aren't going to do that, right? Because they like that functionality. They like to be able to communicate with customers and communicate with potential employees and all that other good stuff. I don't think we're going to see a lot of planning around this.
Yeah.
Right. Absolutely. And all, as Jorge mentioned, there's some opportunity for some litigation, which something like this, we may see it.
Yeah,
So
I don't think it's an opportunity, Mo. I think it's a certainty that you'll see it.
So, but just because there may be some litigation doesn't mean you can ignore it and wait for whatever that ends up being. With 89%, I'm going to go ahead and close this poll and move into the results. About 40% said yes, which I wasn't thinking it would be that high. That's really interesting that there's that many 86272 positions. So there's homework for that group of attendees. If you take a position, if you're thinking about taking a position, you need to get familiar with this guidance as states will likely address this beginning in 2022 sessions. Okay, moving on. Nexus. So Nexus is an interesting topic for us. It's an important topic in state and local tax. At one point in time, I think the first time David and I did this, half our presentation was Nexus. Now we're relegated to maybe 5 minutes, maybe 10 minutes. It's still a very important update and worth talking about. On the Wayfair side, every state has now enacted a market activity threshold for sales and use tax Nexus. Physical presence Nexus still exists, and every state has adopted a market activity threshold. The last year, a couple months ago, Florida and Kansas, effective July 1st, 2021. These also include marketplace Nexus, so marketplace has been adopted in every state as well. If you sell in a marketplace, or if you are a marketplace yourself, you sell other people's goods, this need to know every state has adopted it. Missouri also adopted it. That's effective January 1st, 2023. That's not a typo. It is 2023. A couple of things to consider. There are some home rules. Alaska, which doesn't have a state tax, they have 100 local jurisdictions with sales taxes up to 6-7%. A lot of those local jurisdictions are also adopting their own Wayfair provisions. So if you provide services or goods to Alaska. Colorado, with a lot of home rule jurisdictions as well, adopting their own Wayfair provisions. So that's good to think about. Why are we mentioning this? We know non-compliance with Wayfair, especially among the middle market, continues to be fairly high. The audits are occurring. It's very, very easy to catch someone who's a remote seller. You can go on a website. You can read a 10K report. You can order something. So compliance is high. Wayfair-related audits are occurring. Nexus questionnaires are being sent, and there's no more wait and see here. I think that's really the takeaway for Wayfair sales and use tax, for sales taxes. There's also expanded income tax Nexus, and right after. Or a year or two after the Wayfair decision, we saw this quite a bit with, we had the Texas franchise tax adopt a $500,000 threshold. Massachusetts, Pennsylvania adopted, I think, $500,000 thresholds. Hawaii adopted the same threshold for their sales tax, $100,000 and 200 transactions. Then it was quiet last year. 2020 wasn't a big year for legislation. This year we had Maine adopted a factor presence standard effective 2022. So, state budgets are rosy right now. They're actually pretty good. But I would keep an eye on the expanded income tax Nexus, especially factor presence. I know there's a lot of push among some state tax advocacy groups to incorporate factor presence as more of a standard nexus requirement in most states as we go forward.
Yeah.
I don't know, David, Jorge, if you have any. Yeah.
No, absolutely right, Mo. And I think in terms of on the sales tax side, I think Florida's adoption of a waiver standard is the really big item there. And in terms of on the income tax side, I mean, look, we know states have had economic nexus on the income tax side for a while, right? What's that key case out of South Carolina, Jeffries, from a couple of years ago, 15 years ago, 20 years ago, whatever it was. And so it's been around, and states have directly or indirectly incorporated it in various respects. The question now on the table is how much more so in light of post Wayfair. And the problem in terms of the jurisprudence and the Supreme Court's guidance is that all of the nexus cases in terms of Commerce Clause nexus involving income tax issues have involved, at least from my recollection, have involved physical presence, right, of the taxpayer, the fact pattern that they're looking at. So that's really the key question is, what is the extent to which there's any possibility of pushing back? And I think the post-Wayfair world, it looked bleak for pushback against expansion of economic nexus on the income tax side. That's my personal view, at least.
Something to keep an eye on.
Yeah, but I mean, my view, Mo, is I think the sales tax questions are pretty settled right now. I mean, there's still issues out there, obviously, but the big picture issues are pretty much settled. I think the action's going to turn to the income tax. I happen to agree with Jorge, and I think you're going to see a lot more states adopt factor presence standards, the ones that haven't yet. And I think that's going to be the trend in the next couple of years. And by the way, I'm not sure that's a bad thing because it adds a little bit of certainty to the process, right? If you know what your factors are, you'll know whether you have nexus or not. And
one last
not a bad
comment.
thing in terms of certainty, but maybe not a great thing for cents and dollars for some of these companies. But yeah, absolutely, David.
Right. Well,
one
yeah,
last
right.
comment too with the amount of remote work occurring now, a lot of employees are creating nexus for their employers, and we might briefly talk about workforce. That's another reason to think about nexus right now. If you have an employee in another state performing their duties full time and you didn't otherwise have nexus in that state, you do now with that employee. So moving on, M&A, and we had an M&A session this week. I would encourage you to pull that out and listen to it. But Jorge, you want to tell us a little bit about what you're seeing on the state and local side, because it's been very active.
Yeah, no, thank you, Mo. Absolutely. M&A has been a very exciting time in the M&A arena. Acquisitions, exits are extremely hot, buyouts of all kinds. And look, I think there, as you mentioned, there was an M&A panel that people should cross-reference that goes into all of this in greater detail. But from the state tax side, I think the takeaway continues to be, in fact, more than ever, the importance of working with state M&A tax advisors. A lot of times, the deals will have M&A deals will be reviewed almost exclusively on the federal side, and it's very important that in-house advisors and external advisors, CFOs and in company staff really take a look, both on the buy side and on the sell side. Take a look at also the agreements, right? What are the shifting provisions for indemnification, for instance? Escrows, escrow issues can come up in all kinds of way. But in terms of numbers, I wanted to share, I think, $500 billion of deals for the first half of 2021 and up to 3/4 up to where we're at right now. The uncertainty at the federal level, I think, helped push a lot of those deals over the edge. And you have also demographic shifts and all kinds of major tectonic economic forces driving these deals. And I think that that's going to continue well into 2022. Regardless of what ends up being the print for the federal legislation. But I think the change on the capital gains rate changes as to potential changes as to safe harbor for qualified stock also comes into play. So bottom line is, I think diligence is more important than ever. Federal tax diligence, state tax diligence, working all of that in a coherent fashion, I think adds a lot of value on these deals, adds certainty, and prevents issues down the road. So look at the reserves, look at the liabilities that have not been properly addressed. And again, as we're covering here in this presentation, very important for companies in a merger or acquisition posture to take a look at, what might be the impact of the deal is going to close next year? What might be the impact of this 86-272 changes, pre-deal, post-deal, during deal, right? Sales use tax issues come up all the time as well, transfer tax issues. We also have to keep in mind, in terms of mergers and acquisitions, the impact on nexus from these expirations of these safe harbors in terms of employees, remote workforce. All of that comes into play, and it takes time to do that analysis, or to do the analysis of how all of that intersects with the federal diligence. So involve your tax advisors, federal and state, early, I think is the key takeaway. More deals are on the way.
Yeah, and I will say, Jorge and Mo, we do a lot of due diligence work here at RSM, and it is becoming much more, as Jorge said, much more sophisticated, much more complicated. There's lots of moving parts, and I want to echo what he just said. Get on this early and talk to your SALT folks, because a lot of times they bring the SALT folks in late in the game on due diligence, and it's that tends to be a mistake.
Absolutely.
Get in early.
And one more. Absolutely, David. And one more thing I'll just share anecdotally. I have seen, in my experience, situations where even a change in case law, it may not be from the highest court of jurisdiction in that particular state, but nevertheless, there could be a change. There could be a new case. There could be a powerful dissent, for instance. So not just looking at the statutes, not just looking at the regs, but also looking at the case law out there is very important, because there might be a position that either on the buy side or on the sell side that have a tremendous impact on the numbers on the state side, and that can affect all kinds of things outside of the tax arena, whether state or federal. So absolutely, David.
This seems really like a cornucopia of issues just by itself, Jorge. So I want to talk about past serenity workarounds as we head to the end of the session. I do want to give two quick updates on this. There are a number of federal proposals that may change the cap. I want to read those to you. One proposal would increase the cap to $72,500 and extend it to 2031. Apparently that's revenue neutral. Interesting, that would be effective 1/21. So that would be effective for 2021. Another proposal floated, keep the cap at $10,000, only have it apply to earnings over $400,000. So there's some movement there. We don't really know what the cap's going to look like, but it looks like maybe there will be a change of some sort. Jorge, by the beginning of 2022, regardless, we're going to have at least 20 states with a past serenity workaround here. This year we had 13 or more states adopt a workaround. What do we really need to know if you're a past serenity, or if you're a corporation with past serenities and you're considering an election?
Absolutely, Mo. That's a great question. And again, we had a panel cover some of this in greater detail than we'll be able to do here. But the takeaway is the tremendous importance of pass-through entities of all kinds being aware that this workaround is out there. I will say that, first of all, there's uncertainty even at the Fed, putting to the side the question of whether the cap is going to go away, which is very much an open question, as we all know. And I think just this past week, right, there were 2 or 3 different versions on the House side of what a cap repeal or temporary repeal might look like. So it's kind of mind-boggling. From a policy perspective, and to sort of tie that out to practical considerations, I think one of my big takeaways is be careful what you wish for. We know the workarounds are beneficial to lots of taxpayers, lots of flow-throughs, S corporations, and partnerships. That in and of itself requires an extraordinary amount of analysis depending on how complex the backdrop is, right, of the specific taxpayer situation. You may have multiple tiers of partnerships. You get into all kinds of questions and issues in terms of resident tax credits. Are they going to apply? Computationally, it gets quite complicated. But from a policy perspective, I think from my point of view, the big takeaway is be careful what you wish for, because I think that regardless of what happens on the federal side, I think these workarounds are a further segue or further corroboration of the trend of states essentially taxing pass-throughs at the entity level. And we have the UBT in New York City. Obviously, that's been around for a while. We have some other examples of that. But we have the trends, for example, with California and the LLCs and other examples of that. So I think some of this, it's true that some of the legislation for these workarounds was tied or is tied to specifically to the TCJA. So to the extent that the cap goes away, that might need to be remodified. But I think it's a canary in the coal mine, or whatever metaphor you want to use. I think states will continue to seriously look at how to tax pass-through entities at the entity level or some hybrid of that. And actually, before I forget, I want to mention that the MTC, we're talking about the MTC's guidance in terms of 86-272. I think the MTC is deadly serious on this study of partnership tax rules, and that's been percolating in the background. And now that they're getting traction and people are arguably paying more attention to what they're doing, I think this partnership tax project is gonna push states to do what I'm saying here, which is basically enact entity level taxes on pass-throughs, which, by the way, going back to big picture and going back to M&A and going back to acquisitions and exits and all of that stuff, I think it's also an opportunity for taxpayers and advisors, external and in-house, to say, do we need to take a look at our structure? Do we need to possibly go to a C Corp, right? The TCJA already provided that incentive in terms of lowering rates. So lots of dynamism in the state tax arena, and these SALT cap rounds just add to the incredible complexity and the importance of working with your state tax advisors earlier rather than later. There's elections that had to be made by date certain. Some of those have come and gone. I'll mention, I don't know if we'll have time, there are some state tax amnesty programs out there. So I think it's interesting. I think Connecticut, Louisiana, and a few others recently put out amnesty programs. So it's interesting to think about those amnesty programs as a way to maybe get into the workarounds, to the extent that there are companies out there that have not availed themselves of the election. In addition to
Jorge. So really the takeaway here, especially, is if you're a multi-state partnership and you're considering one of these elections, you really need to be thinking about modeling, and you also need to be paying attention to what's happening at the federal, and we will absolutely cover that from the RSM perspective as that occurs. So moving on, workforce. I think we mentioned very briefly, but continue to track your workforce, know where your employees are. This is going to be a nexus issue. We do have an hour presentation on this that was presented yesterday. I would encourage you to look at that. The hybrid workforce is here to stay, and some hodgepodge of a few other issues. State transfer pricing audits. We have Indiana, North Carolina, and Louisiana with transfer pricing audit programs right now. And that's really starting to pick up in a way that we haven't seen in recent years, and maybe there's new expertise involved, and that's why. Expansion of digital taxes was mentioned a couple of times, both sales tax and expansion of digital goods, but also digital ad taxes. We have one in Maryland that's going to be effective in 23, and under litigation both in federal and state court. And also just paying attention to the federal changes as they occur. We know there's going to be some federal income tax change, especially on the international side, the pass-through entity workaround, maybe business interest as well. So we need to keep an eye on these things. Our last polling question today: what state tax issues are you most concerned about? State conformity to ever-changing federal requirements pertaining to PPP, 163J, GILTI, NOLs, and other issues, last-minute impact of new federal tax laws on the states, lack of tax authority guidance after an active year of legislative changes, or more than one of the above. Of course, right now, I think we only have 10 states in session, so to the extent there are retroactive changes, I did see a question. Someone asked about whether the MTC guidance would be effective to January 21 if a state adopted that guidance. It doesn't look like to us that any state will be adopting it in 21, but that's a legitimate concern. I think if you look at what happens at the federal level, states are about to jump into their sessions for 22, and hopefully there's some time to address these things and think about them. But again, during the TCJA, that didn't happen right away, and in some cases, states still are responding to the TCJA years later.
Yeah, absolutely, Mo. And I was going to add on the transfer pricing front. I think that's very important for companies and clients to be aware of. It's not just separate reporting states; it's primarily separate reporting states, which tends to be in the Southeast and somewhat in the Midwest. And the states are becoming incredibly sophisticated relative to 15 years ago. This has been around. It's called the CITUS project out of the MTC. They're hiring economists. They've been working with economists, and states are going to bring that expertise to the table, adding even more potential exposure to clients that need to really consider what their intercompany transactions are.
And it sounds like most of you are concerned about more than one of the above issues. I think that's pretty accurate. So if you've asked a question, we're going to try to get back to you. The three of us will be in the chat lounge immediately after this session. We do have one more polling question as well. Would you like to hear more about, or would you like to talk about any of these topics with an RSM professional? Yes or no? So we'll take a look at your questions. We will
the answer is
jump over to the chat room as well. We hope so. We hope so.
Yeah.
And then I think with that, Allison, do I hand it back to you?
Yes. Thank you so much, Mo, and thank you to Jorge and David and to our audience for joining us. As Mo mentioned, they will be in the networking lounge immediately following this event, so please join them over there for additional conversation. If you have met all CPE criteria, you may download a copy of your certificate by visiting the Certification Center and click the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude our event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. And we invite you to join us for the final 3 sessions of Tax Summit Week coming up at 12 o'clock Eastern Time, Canadian Income Tax in 2021 and 2022. At 1:30 Eastern Time, Planning During Uncertain Times, Tax Trends and Issues Affecting Individuals and Business Owners. And our final session today at 3 o'clock, Full Speed Ahead, Year-End Tax Planning. Thank you so much for joining us for this Tax Summit session. We hope you have a great day, and we'll talk with you soon.